A second passport is often presented as a simple solution for international travel and long-term security. Many programs highlight the visa-free travel access, the global flexibility, and in some cases, potential tax advantages. For international families, these benefits can sound very attractive. However, the citizenship interacts with a much larger legal and financial framework. A passport does not exist in isolation. It sits alongside the tax residency rules, banking compliance, inheritance tax laws, and location of your assets. When these elements are not coordinated properly, a second passport can introduce complexity rather than reducing it. Many high net worth individuals discover this only after the passport has already been obtained. The marketing around citizenship program usually focuses on mobility and lifestyle benefits, while the structural implication receives much less attention. My name is Shiraz Wahid, and in this video, I'm going to cover exactly those structural aspects. One of the most common misunderstandings around the second passport is the assumption that obtaining a new citizenship automatically changes how you are taxed. In practice, most tax systems does not operate this way. Tax obligations are normally determined by residency and sometimes by domicile, rather than the citizenship alone. Residency generally refers to where you physically live during the year, where your economic activities take place, and where your personal and financial connections are located. If your residency does not change, your tax exposure usually does not change either. For example, someone may obtain citizenship through an investment program in the Caribbean while continuing to live and operate their business in Europe, Asia, or Middle East. From a tax perspective, the authorities in the country where that the individual is residing will still assess their income and activity under the same rules as before. This is why many international tax advisors emphasize that citizenship planning must always be coordinated with residency and tax planning. A passport may provide options, but practical tax outcome depends on where you actually live and conduct your affairs. Another factor that sometimes arises is the reporting obligations. When individuals hold multiple citizenships, theoretically, institutions may ask additional questions regarding tax residency declarations. This is part of the global reporting framework, such as the Common Reporting Standard, which many countries now participate in. Ultimately, a second passport does not automatically restructure your tax exposure. Residency, domicile, and location of your assets continue to play the central role. Another practical issue appears in the banking system. Modern banks operate under the strict international compliance rules. These rules require institutions to understand the background of their clients, their source of funds, and the jurisdictions connected to them. This process is known as due diligence. When you introduce a second citizenship in your profile, banks often reassess your compliance profile across several dimensions. They may review your residency, the location of your business, and the countries connected to your citizenship. In practice, different citizenship programs can be perceived differently by financial institutions. Some private banks may have historically applied additional scrutiny to passports from newer citizenship by investment jurisdictions simply because the compliance team are less familiar with the program. By contrast, passports from longer and established citizenship by investment program are sometimes processed more smoothly because banks have already built internal compliance framework around them. In many situations, this is straightforward. However, certain citizenship programs may be viewed by some financial institutions as higher compliance risk. When that happens, banks may request additional documents or take longer to open accounts. For internationally active families who rely on stable banking relationships, this can become an important practical consideration. The key point is that citizenship planning should not happen in isolation from banking strategy. Banks look at the complete picture that includes residency, business activities, asset location, and governance structures. When the overall structure is clear and credible, second citizenship usually integrates smoothly into the financial system. Another element that is often overlooked is the long-term stability of the visa-free benefits. Second passport programs are frequently marketed based on the number of countries that allow visa-free travel. These lists can be impressive and they do provide real convenience for international travel. However, visa agreements between countries are not permanent. Governments review these arrangements regularly based on diplomatic relations, immigration policies, and security considerations. There are practical examples with different citizenship by investment programs where their visa access changed. For instance, for a limited period of time, the European Union suspended visa-free travel for passport holders from Vanuatu after concerns were raised about due diligence standards in its citizenship by investment program. This decision significantly reduced the mobility value of that passport for international investors. In other situations, Caribbean programs have periodically faced review by European Union and United Kingdom. These reviews do not automatically remove visa-free access, but they demonstrate that mobility privileges are always subject to political review. For families thinking about international mobility over decades rather than years, this means that the passport should not be viewed as permanent guarantee to travel access. Instead, mobility should be approached as one component of a broader international positioning strategy that may also include residency planning and regional diversification. There are also cases where governments have introduced reforms specifically to protect mobility access. Several Caribbean countries, including St. Kitts and Nevis, Dominica, and Grenada, have strengthened the background checks and regional information sharing in response to international pressure. These reforms were designed to maintain visa-free agreements with major partners such as the United Kingdom and the European Union. Citizenship can also interact with inheritance law in ways that are not immediately obvious. Many individuals assume that succession planning depends only on where their assets are located. In reality, several legal systems may influence inheritance at the same time. Citizenship, residency, and domicile can all play a role depending on the jurisdictions involved. Some countries apply what are known as forced heirship rules. Under these rules, a portion of a person's estate must pass to specific family members, such as children or spouse. Other jurisdictions allow individuals greater flexibility in deciding how assets should be distributed. When multiple citizenships and multiple jurisdictions are involved, succession planning can become fragmented. Different courts may claim jurisdiction over different parts of an estate. This is one of the reasons why international families often rely on governance structures rather than leaving assets directly in their personal names. Structures such as foundations, trusts, or holding companies can centralize ownership and define how assets should be managed and transferred across generations. The objective is continuity. Instead of relying on personal legal status of an individual, the structure itself defines governance, control, and succession rules. Citizenship programs may carry reputational considerations as well. Governments, financial institutions, and international organizations review these programs regularly. Some programs maintain strong reputation because they operate under transparent legal framework and strict due diligence procedures. Others have faced criticism when regulatory oversight has been weaker. For example, Cyprus' Citizenship by Investment program was widely reported in international media, and investigative journalists claimed that certain applicants were approved despite compliance concerns. Following that controversy, the program was ultimately closed. Similarly, Malta's Citizenship by Investment framework, known as Granting of Citizenship for Exceptional Service program, faced sustained scrutiny from European institutions. In April 2025, the European Court of Justice ruled that the structure was incompatible with EU laws because it effectively granted EU citizenship in exchange for investment without a sufficient genuine link to the country. Following that decision, the program was discontinued in July 2025. The ruling demonstrated that citizenship programs connected to larger political unions, such as the European Union, can face legal challenges that reshape or even terminate those programs. On the other hand, some programs have maintained a stronger long-term reputation. St. Kitts and Nevis, for example, operates the oldest citizenship by investment program in the world. Over time, it has built a reputation for relatively structured due diligence procedures and regulatory reforms designed to maintain international credibility. For high net worth individuals who operate internationally, reputation matters because it influences how banks, counterparties, and regulators view the overall structure. If a citizenship program is associated with strong governance and transparency, it tends to integrate more easily with international financial system. When regulatory perception is weaker, banks may apply additional scrutiny. The final risk I want to discuss is the one that many investors do not consider when applying for a second passport. Citizenship obtained through investments program is granted under specific legal conditions. Governments retain the authority to review and revoke that citizenship if those conditions are later found to be breached. In most programs, this relates to due diligence. If new information appears after citizenship has already been granted, authorities may reassess the application. This can include background checks, source of funds verification, or undisclosed legal issues that were not identified during original process. There have been cases where governments later cancelled citizenships that had previously been approved. Caribbean countries have periodically announced reviews of previously granted passports where authorities claimed that information provided during the application process was incomplete or inaccurate. In addition to that, citizenship by investment programs operate within international political framework. From time to time, governments offering these programs face external pressure from larger jurisdictions to strengthen vetting standard or review past approvals. For example, several Caribbean programs have faced coordinated diplomatic pressure from UK, US, and European Union to strengthen due diligence standards and improve information sharing. This means that the long-term stability of the passport partly depends on the credibility and regulatory strength of the program itself. For clients looking for a second citizenship, it is therefore important to understand that the passport is issued under a legal program rather than as an unconditional entitlement. The strength of the program's due diligence, transparency, and regulatory oversight plays an important role in determining how stable the citizenship remains over time. In this context, citizenship becomes one component of the international framework rather than the foundation itself. When citizenship planning, residency planning, and asset structures are aligned properly, families achieve a much more stable global position. So if you want our help evaluating which citizenship program may suit your overall wealth framework, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.